What would happen to your debt if the dollar collapsed? I mean, if the currency that you borrowed a bunch of money in was no longer worth what it once was, and there was an abundance of it available thanks to hyperinflation, wouldn't that make paying off your debt substantially easier? And if the currency got replaced completely, wouldn't that wipe out your debt? Well, not exactly. And in this video, I'm going to discuss currency collapse, what you need to understand about how it happens and the mechanisms in place. Then I'm going to discuss what would happen to your debt if the US dollar did in fact collapse. And then I'm going to talk about how to prepare yourself and protect your money so that in the event that the inevitable, or maybe the not so inevitable, actually happened, you would be prepared and not find yourself in financial ruin. But before I get into all the details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, if at the end of this video you found it interesting or you found it informative, hit the like and subscribe button so more people like you can see this video as well. It really helps for the YouTube algorithm. Okay, so let's get into it. Let's discuss currency collapse and how it would affect you. And specifically, I'm going to talk about your debt, your assets, and how to protect yourself in case this crazy scenario that is seemingly more talked about and more popular to talk about than ever actually occurred. In order to understand what would happen to your debt and the value of your assets, first we need to start by understanding currency collapse and the basics of why this happens. Now, as much as many people would like to have you believe that the US is at serious risk of a currency collapse because of all the money printing and all the other stuff that, by the way, happened in pretty much every other country around the world and in pretty much relative terms to the US, the reality is that there's some mechanisms involved with currency collapse that make it a little less likely for the US to find themselves in a similar situation, but also make it highly likely that there are going to be other countries that do find themselves with a currency that is devaluing at a very significant pace. A lot of the currency collapse that's happened over the last century is largely due to something called fixed currency exchange or pegged dollars. In fact, pretty much every country over the last 100 years, going back to Germany in 1920, whatever it was, well, pretty much all of them had a pegged or fixed currency, either a currency that was pegged to another currency or was pegged to something like gold or silver or petroleum, for example. And floating currencies rarely experience the same sort of issues. The reason for this is because a currency like the Canadian dollar or the US dollar or the British pound or the Japanese yen, I think it's called. I always get the yen and the won confused. The won, by the way, is very much a fixed currency, although it is revalued on a daily basis. But pretty much any floating currencies have one thing in common, and that is that the values of those currencies fluctuate with supply and demand. So if there's something happening in a country that makes investors scared to be there, well, the market prices in those potential issues, and that's why you see different currencies fluctuate relative to other currencies on pretty much a minute-to-minute basis. It is because the real-time issues that are happening in those countries are being priced into the values of the currency. That's also why you see that when a country increases interest rates, typically the value of their currency goes up because it becomes a place where people want to invest their money in exchange for higher return. And in the same way, if you see interest rates going down relative to other countries, like what could happen in Canada in the next little while, well, then the currencies come down in value. And that is because there are less investors that want to invest in a place where they can get lower returns. It's really a simple mechanism that controls the values of those currencies. But the problem becomes when a government or a central bank pegs their currency or fixes it and says it is worth this much until we tell you it is worth something different. And the problems happen in countries that have fixed exchange rates when the sentiment in that market shifts. So in other words, when investors no longer believe that the value of the currency is what the government is telling everybody that it should be. And this is very much what happened in Germany, Venezuela, Brazil, Mexico, and pretty much every major currency devaluation in the last 100 years. Essentially, the government had a currency that they said was worth X, and investors said, it seems like it's worth significantly less than that, so we are going to get the heck out of Dodge, sell all of this currency, and that is when major problems start to happen. And not only that, in the same vein, citizens of the very country that the currency is in also start to sell goods and try to exchange their currency in the country that they live in, which they start to believe is not worth anything, in exchange for foreign currencies in order to protect themselves. In fact, if you look at Venezuela, almost half of all trade in Venezuela is now done in US dollars, as much as Venezuela absolutely hates the fact that the US even exists. at least, of course, from an economic standpoint. Now, there's a bunch of things that can lead up to these massive devaluations. The first is when it becomes clear that an economy is not going to be able to pay its debt. This often comes when there's low growth, lots of spending, and a tax base that just cannot afford to be able to pay the debt that they owe to other countries. Now, of course, there's always lots of talk about the US debt and how it's so high and the debt to GDP ratio is high. But the reality is the cost of servicing that debt is still very much in line with what the US can afford, based primarily on GDP and the amount of money that the economy is essentially creating. So, if the economy is growing and it's growing at a rate that is faster than the cost of servicing the debt, well, everything is pretty much fine. And by the way, at the end of this video, I'll link to another video that explains the difference between the debt to GDP ratio, which is the alarming number that you see in the news every single day, and the actual cost to service the debt, which historically is actually not as high as one might think it is. And this is largely due to lower interest rates. Now, when it comes to these currency collapses, the actual printing of money and the excess amount of money that is being pumped into the system is usually not the actual disease. The disease is very much the economic conditions that the country is facing. So, the hyperinflation or the devaluation of the currency is the symptom, but there's usually something else going on in the country that no longer allows them to be able to A, support the fixed value of their currency, and B, actually be able to earn enough income in order to be able to support the debts. Now, of course, the devaluation of the currency can be offset by increasing interest rates. The problem with that, though, is when you already have an economic catastrophe that is leading to hyperinflation and having to print money, if you start to increase interest rates without solving the original problem first, well, that makes pretty much everything less affordable, while at the same time you have the inflation and still have all the underlying problems, which basically leads to more hyperinflation because eventually you have to either print more money or you have to lower interest rates, both of which are, of course, inflationary. So it becomes this endless loop that is caused by the economic conditions that have led to it. And when you see investors and citizens basically flocking away from the currency of a country, it is most often very directly a government related issue. It is a lack of confidence in the current administration to be able to provide the necessities, which is, for the most part, economic growth that is required to support the currency and to support the citizens. So pretty much everyone gets out of Dodge, and all of a sudden you have a currency that's collapsing. So then the question becomes, what happens to debt? Well, first we need to understand the different types of debt. Of course, there's the basics. There is the credit cards. There is the short-term notes, which is things like lines of credit and other short-term notes that are expected to be paid back pretty much when they are called by the bank. Then there are the car loans and the mortgages. Now, obviously, credit cards are problematic because of their extremely high interest rate. And these are just things that nobody should have at any given time. And somebody who has them, even during a currency collapse, is very much leaving themselves exposed to a situation where they will not be able to pay their bills. And when hyperinflation happens, or the value of the dollar goes down, or whatever currency it is, well, that leads to not having enough money to A, be able to pay the credit cards, but also the credit cards are typically a symptom of overconsumption. And if you're overconsuming and the value of the dollar goes down, well, that leads to just more overconsumption. And it's just very much a signal of bad habits that are not going to get any better when hyperinflation rolls around. Then there's short-term notes. And these are the types of credit facilities, the types of loans that are probably going to be called first by the banks. Anybody who has borrowed off a line of credit or has any sort of borrowing that's been done on a short term is probably going to be asked to give the money back, because the expectation is that if they borrowed it on a short-term basis, that they're probably going to have the money available to pay back those loans quite quickly. So those become the low-hanging fruit. Of course, in a hyperinflation scenario, if you've got debt that's called and you can't find the money in order to pay back that debt, well, that becomes problematic. And of course, you've got car loans, which it's my belief are the number one wealth killer in the world. And these are the types of loans that are still secured against something, but that doesn't necessarily mean that they are the best type of loan to have either. Now, the last one, which is mortgages, this is the type of loan that you have in order to obviously own a home. And this is the one asset that, pretty much regardless of what's happening with the currency, is probably going to remain relatively stable relative to all of the other assets. Now, of course, when you have a currency crisis, you're going to see a certain amount of people trying to leave the country, but for the most part, a large majority will stay in the country, which means they all need a place to live, which means that property relative to most other assets is probably going to do very well. Now, that doesn't mean it won't go down in value. It'll just do well relative to everything else. So if you can own property or own multiple property and own it debt free, well, you're going to be the type of person who has the least pain when there is a currency crisis. Now, one might believe that during a currency crisis, when there's hyperinflation, there's going to be so many more dollars available relative to the amount that are outstanding on your loans, and that this should make it pretty easy to wipe out any debt that you have. And this is partially true. Yes, hyperinflation can make your debts easier to pay if you can, in fact, get enough currency to pay off those debts while also trying to pay for all the other necessities that are going up significantly in value as you are trying to buy them. And that hyperinflation is very much an indicator that there is a significant amount of economic instability, which means it could be harder to get a job, it could be harder to keep a job, and it could be harder to actually maintain assets that are going to grow in value with the amount of debt that you have. Or I guess not really with the amount of debt that you have, but with the amount that prices are going up. Because when things are getting more and more expensive on a day-to-day basis and the amount of dollars available aren't keeping up to that, well, that makes it very hard to find the funds to be able to pay for the necessities, let alone pay for all the debt obligations that you have. And I cannot emphasize enough that one of the biggest problems in a currency crisis is that there aren't enough jobs to allow people to make the money that they need in order to have the necessities, let alone pay the debt. But that doesn't necessarily mean that you're going to get off scot-free just because the value of the debt is going down and because you don't have a job to pay for it. Because in the past, you may have been able to default on a loan and only the bank that lent it to you would know. But in the modern era of credit bureaus, that isn't the case. And I'll get to that in a second. So, what inevitably happens in a currency crisis is that eventually the debt either gets completely repriced or it gets replaced. And what happens with debt is that inevitably that debt gets repriced as well, either in whatever currency replaces the original one or whatever ratio that is deemed to be the correct ratio when there's a revaluation that takes place. So, what that means is that just because you have a debt that is so much smaller in valuation relative to where the value of the currency went, when the debt actually gets repriced, you're pretty much going to have your debt completely repriced in line with that so that your obligation to the bank is essentially going to be the equivalent of what it was before. And even though your contract for your debt would have been in one currency at one valuation, the types of revaluation that happens has nothing to do with your contract with the bank. It has everything to do with the government. And when the government mandates that there's an adjustment in the currency, that applies to everything, including your debt, regardless of what the contract stated. So if your contract is in US dollars, but the US dollar is replaced by something completely different, well, you're pretty much screwed because your debt is going to be repriced into whatever the new currency is, anyways. So your debt doesn't disappear. And in fact, because of how much harder it is to make money and keep money during an economic crisis, well, your debt could actually be more burdensome than it was before. Because governments always protect creditors, they have to. If they don't, they lose the very mechanism that allows the money supply to actually work and actually be traded. So when it comes to debt, there's very rarely a debt jubilee. Once you have the debt, expect that you're going to have to pay it off, regardless of if the currency that you borrowed it in is different than the one that exists when the currency collapses. But that's not even the bigger problem because that's a problem for the economy as a whole. But as an individual, there's one thing in the modern economy that we haven't had in the past when there's been currency collapses, and that is modern day credit reporting, which keeps track of who pays their bills and who doesn't pay their bills. Like I said before, it used to be that if you borrowed from a bank and you didn't pay them back, you could go and build a relationship with another bank and then you could get loans again. But now in the modern day, if you default on a loan, that's going to be reported on your credit bureau, which means not only is it going to be really tough right now, but for the next 7 years at minimum, you aren't going to be able to borrow any money, if ever at all. So in the past, where a currency crisis would mean defaults on debt, and then you wouldn't have any issues because eventually when things recovered, you could go and buy new money to buy another home or whatever. In the modern world, the people who pay their bills will be the people who can borrow money, and the people who don't pay their bills will be pretty much out of luck. Even though there was an economic circumstance that warranted the not paying of the bills, the fact that you had taken on too much debt obligation where others had been able to pay makes you less worthy of being able to get a loan, which makes life a lot more difficult. So the question is, how do you prepare? Well, the preparation for a currency crisis is the exact same preparation that, well, you should pretty much be doing regardless. And the first thing is to keep your baseline low. And what I mean by that is most people, as their incomes go up and as their investments increase in value, they start to increase their run rate. So they start to spend more money in line with the new money that they have. But the trick to being financially free is to keep your baseline low. So, in other words, your monthly expenses on any given month shouldn't be increasing regardless of if you have more money in your investments or making more money. If you can find a living situation that is perfect for you, doesn't have to be extravagant, but doesn't make it so that you aren't laying out more and more money as you earn more and more money, well, that will give you the freedom and the tools that you need in order to be financially independent. And most importantly, that will also allow you to pay down your debt faster because buying one home and paying it off as your income increases is a significantly better path to wealth than buying one home and then when your income increases, buying a nicer home that you probably don't really need and is just bigger and harder to clean. Now, in addition to keeping your baseline low, it also makes a ton of sense to set a personal debt ceiling. So for me, I like to keep this at no more than 25% of my income going towards any sort of loan obligations whatsoever. I know that if it never increases past 25%, I'm pretty much good. And I set this debt ceiling based on my income at the time I set it. It's a debt ceiling for a reason. You don't increase the debt ceiling as you make more income, you leave it constant over time. And then if you make enough money to have a couple extra 100 grand that you can buy a new property with while maintaining no greater amount of debt, awesome. But you want to do everything that you can to, over time, make sure your debt is minimized. And if you just keep your debt ceiling at the level that it's at today, in 20 years, if you have no more additional debt, well, your debt relative to what it was 20 years ago is actually going to be significantly less and is significantly more manageable, which, if the currency ever actually collapses, means that you're in a position to actually be able to pay it off and get rid of it should the writing on the wall suggests that you need to take protective action. Then, in addition to that, if I don't need to keep the debt at that debt ceiling, I want to consistently try to reduce that debt over time and get it to zero as fast as I possibly can. Because here's the thing that people don't understand about debt is debt equals risk. Having debt allows people, companies, governments to come and take your stuff when you don't repay loans. And if you don't have a loan, well, it makes it pretty hard for them to be able to take your things. So getting rid of debt reduces your risk to zero, and zero risk means that no matter what happens in the economy, you are protected. Then, in addition to that, you want to be buying assets that retain value relative to other things when there is an economic crisis. So, even though the values of real estate went down, for example, in 2008, relative to pretty much everything else, they actually maintain their value pretty well, especially when you look at the values of stocks. So, if you buy assets that, relative to everything else, are going to maintain value, so these are hard, tangible goods that nobody can take away from you, well, that protects you from currency fluctuations because even if the currency fluctuates up, down, all around, it doesn't matter because a house is still valued at the value of a house relative to everything else, like a car and so on and so forth. So even if the currency fluctuates, owning things that are going to maintain their value relative to foreign currencies is a really good idea. And then last but not least, if you are really concerned about a currency devaluation, one of the best things you can do is diversify your assets geographically. So, in other words, buy assets from other nations. So, the reality is, in a currency crisis, it's not about whether or not your debt is going to get canceled because it's not. It's all about what you own and how much you owe. And the less you owe, the less risk that you have. So, owning things like real estate, cars that don't have debt, land, and gold, although don't put all of your money in gold because if the currency doesn't collapse, that might not be the best investment. There's other videos on this channel about that. But having those tangible assets that you don't owe any money on, that nobody can take from you, are what helps people in an economic crisis survive. It's all about owning tangible assets, not having any debt. And then on top of that, if you are genuinely worried about the dollar collapsing, well, then it makes sense to start buying at least some foreign assets. Not all foreign assets. I'm talking about 10, 15, 20% of your portfolio being in foreign assets that are denominated in foreign currency. This might mean buying stocks on foreign exchanges. It might mean buying bonds on foreign exchanges. And it might mean owning land in foreign countries as well. Because if you own assets that are outside of your current currency, that is a way to hedge yourself against your currency actually collapsing. But at the end of the day here, the reality is that the US still has one of the biggest economies. And even though those debt numbers are scary and the debt to GDP numbers are scary, the US economy is still the biggest economy in the world, and it is still an economy that is growing. And the growth supports the debt, which means that the fear of a currency collapse, although not impossible, is still unlikely. And keep in mind as well that all the other countries, including the BRICS nations, have a vested interest in seeing the number one trading partner in the world for pretty much all of those countries not have their currency collapse because they do carry a significant amount of US dollars in their foreign exchange reserves, which means if the US economy collapsed and the US dollar collapsed, well, they're in just as much trouble as the US itself. Oh, and if you want to see more on the US debt and the US debt ceiling and why the actual cost to service the debt aren't as scary as you might think, make sure you check out this video right here.